All right, welcome to chapter 10, problem assignment help. All right, we're going to go through this. We have about 10 problems we're going to work on together. And remember, your numbers are going to be different than mine, but that's okay. We're going to work these through so you can follow along. Oak Tree Company purchased new equipment and made the following expenditures. I have a purchase price, sales tax, freight charges, insurance on the equipment for the first year, and installation of equipment. The equipment includes all that other, okay. This person open account, the payment due 30 days. Okay. Prepare the necessary journal entries to record the above expenditures. Okay, so let's go through these and which ones are going to be included in the equipment and which ones are not. So 45,000 is sales tax, yes. Freight charges for shipment, yep. Freight insurance, wait, okay, I was a little off there. Insurance on the equipment for the first year, no, because that's for the first year. It's going to be after installation, but the installation on the equipment will be. Let me break out my handy dandy calculator and we'll find out how much we're going to include in equipment. So we got 45,000 plus 2,200 plus 700 plus 1,000. So I got $48,900. So we are going to debit equipment for this. $48,900. And then let's find out how we do it. The other expenditures were above were paid in cash. So we're going to do the 1,000 and the 700 for the equipment and sales tax on account. So we're going to have that as a credit to accounts payable. And the rest was paid in cash. So the cash amount was the install and the freight charges. So that's 1,700. And then the rest of it is going to be $47,200. Okay. Second one, record any expenditures not capitalized. All right, well, we had the insurance on the equipment for the first year, but the first year hasn't expired yet. It's at the beginning, so we're going to debit prepaid insurance. There it is. Was it 900? Yeah. And I believe it said it paid it in cash. We're going to find out. Let's check our work. Boing. Good job, everybody. Good job. All right. Next question. So for this next one, I paused the video because I noticed this was my lump sum problem. And so I got Excel open for us. And we're going to go ahead and work this one. I'm going to use Excel to help demonstrate it. But we have purchased land and building for $4 million. In addition to the purchase price, Samtech made the following expenditures in connection with the purchase. We have title, legal fees, prorated property taxes for the period after acquisition, and state transfer fees. All right, so first thing we need to do is we need to determine the initial valuation of each asset acquired in these transactions. All right, so what we're going to do is we're going to use our Excel here to determine what those costs are. All right, so sorry, give me a second here. I'm going to do, we had land, building. Was it the total then? Oh, land improvements. Okay. So let's look at the, so did we get a fair value? We should have done a fair value. An independent appraisal land and building is purchased separately at 3.3 million and 1.1. Okay, so our fair value of the land was 3.3 million. And the building was 1100123. Okay, that's right. Let's make these dollars so I can actually see what we got going on here. And then separately spent 82 Actually, we don't want to do that right there. Land improvements are going to be separate on this calculation, but 82,000 plus 40,000 is 122,000. So our land, we need to factor in, we're going to add these up. And we're going to find out what our percentage is for our land by taking the total cost of the land, dividing it by the total fair value. 75% is going to land and 25% is going to the building. Yeah, that's right. Okay, so now we're going to find out what we're going to do is take 75% of 400,000. So we have 300,000. And then sorry, and then we're going to attribute this to the 1 million there. You know what I didn't do? I just did the 4 million. I got to add up all the stuff that's going into that 16, 5, and 4. That was my fault. So we need to add to this 4 million the 16,000. So let me do this. 16,000, 5,000, and 4,000. We're not including the 36,000 because that's after the fact. Okay. So these are our numbers. This is what we should be valuing those at. All right. So let's come down here in our land. Should be 3,018,750. 318,750. Building is 1,006,250. And then the land improvements was $122,000. Okay. Now, what's our next situation? Determine the initial valuation of each asset, assuming that immediately after acquisition, Samtech demolished the building. Demolition costs were $250,000, and the salvaged materials were sold for $6,000. In addition, Samtech spent $86,000 clearing and grading the land in preparation for the construction of the new building. All right, so we got ourselves a what if situation. Okay, so in this case, we're still valuing our total amount of 4,025,000, but this time we're not allocating any of it to the building because it's all going to be towards the land. So we're going to get rid of this altogether. Okay. And then we have demolition costs of 250,000. So I'm going to just add 250,000. And then materials were sold for 6,000. That's fine. And then we graded and cleared the areas for another 86,000. So we're just going to add all this together. And the cost of our land should now be 4,355,000. Building should be 0. I don't know if they want us to put a 0 or not. Doesn't say to not, so I'm just going to leave it blank. And the cost of the land improvements haven't changed. So let's check our answer. It wants us to put a 0 in there, maybe. Okay, they're happy with that. Good. Next problem is, see, I don't know if I need to set this up. Okay, following cash purchases, prepare a summary journal entry to record the expenditures related to initial acquisition. Okay. I don't know that that's going to be too over the top. So let's go ahead and just look into this. So we bought exclusive rights to manufacture and sell the X-Core workout equipment system for 200,000. The exact equipment brand also paid initial 10,000 in legal and filing attorney fees to complete the transaction. So we're going to include both of those as costs to the, what was it, a patent? Exclusive rights to manufacture. I think it's a patent. So we're going to do patent. And it was 210,000. Okay. Do we pay cash for all this? Yeah. All right. Number two, an initial fee of 300 million for a 3-year agreement with Silver Gyms to use the name for a new facility in the local area. Silver's Gym is located throughout the country, but is required to pay an additional fee of 5,000 for each month that operates under the Silver's Gym name, with payments beginning in March 2027. Those are royalties. Those are going to not be. I think it sounds like a franchise. I actually owned a franchise once. Don't ever buy a franchise. Brent also purchased 400,000 of exercise equipment to be placed in the new facility. Those aren't. Are we only focusing on? It doesn't say we're only focusing on the intangibles here. So we're gonna have to do two for this one. $300,000 for the franchise and 400,000 for the equipment. What was it? 300,000. And then equipment was the 400,000. Yeah. All right. Then the last one is the exclusive right to sell Healthy Choice, a book. This book includes healthy restaurant book. Okay, book isn't a patent or a franchise. It would be. It's not a trademark. I guess books are copyrighted, so I'm guessing a copyright for the 25,000. I hope. I think it's copyright. Okay, we're just gonna add up all those. I think that was just the three, right? Yep. 935,000. Okay. Oh, I forgot to put cash, but it looked good. We got all the other stuff. So that was good. Nice. All right. Next one. Jazzin Corporation acquired all the outstanding common stock of Steinbeck Corporation for 11 million. Okay, we're looking at goodwill then. The book value and fair values of Steinbeck assets and liabilities were the following. Book value, fair. We're worried about the fair value. Calculate the amount paid for goodwill. I just don't want to think right now as far as typing it all in. I'll make a mistake. So, accounts receivable is an asset. Land is an asset. Equipment is an asset. Patents are assets. Accounts payable are liabilities. So the book value of, sorry, not the book value, the value of all of that is 10 million. We paid 11 million. So the amount of goodwill is going to be 1 million. And then the journal entry to record the acquisition of Stein Corporation. So we're going to debit accounts receivable. For 1 million. Land, equipment, patent. Accounts payable. Goodwill. Oh, I need to put goodwill first. Because goodwill's an asset. Cash. Land. Equipment. I'm just typing. Oh, I put the wrong one in. Land needs to be 1,500. Did I do that right? Hope I did. Mm. Oops, that was 11, not 10. Hooray. So this journal entry is correct, and the 100,000, 1 million is correct calculation for goodwill. Hot dog. You guys think I don't like I don't try and pre-do these assignments. I want to do them kind of new as I do this so that one, you can see that, you know, an accountant knows this stuff. And second of all, I I also want to experience them the first time along with you. So I'm gonna pause this because this is a long read. Give me a second. Okay, this one's similar to the one I did in the video for this chapter. So we're per the journal entry record the acquisition of the trailer. So let's just start off with the things that we know. We know we're paying $5,000 cash, and we know we're going to have a $25,000 note payable involved here. So those two are going to be um, credits. So that kind of sucks because we're going to have to guesstimate here. I'm going to put the $5,000 cash here, and then the note payable here. All right. So we got to balance $30,000 worth here. So what we need to do is we need to figure out what it is, the amount of the trailer. So remember, we don't have, they're non-interest bearing notes, but an interest rate on 10% property reflects the time value. Okay. So we need to open the present value of an ordinary or a lump sum. Okay. We're going to open up this one. We're going to go to 10% and find the 3 factor. So it's 0.75131. So let me pull this 0.75. And we're going to multiply that by the note. Okay. So this amount, which if we round to 18,783, I think it said to use tables, Excel, or a financial calculator. Oh, whatever. Bottom line is we're going to go ahead and round this to 3. I think it doesn't say what to do, but I'm going to round it to 3. But we got to add this 5,000 to it as well. So our tractor actually is 23,783. 23,783. And then we're going to discount the difference. 25,000 minus, oh, sorry, it should be 30,000 minus 23,783. So we're going to have a discounted notes payable for 6,217. Okay, interest expense in 2027. So our interest expense in 2027, oops, that's not what I wanted to share with you. You guys can pause and read that. That was me buying a car. If you're really bored. All right. So our interest expense in 2027 is going to be the initial amount of the tractor times the interest rate of the note part of it. So I've already, oh, wait, oh, good. I have here 18,783 times 0.1. So we're going to put in 2027 interest expense of 18,778, 1878. Okay. Let's worry about the liability amount in a minute. Then what we got to do is take the 1878 and we're going to add that to our 18,783. So 20,661 and multiply that by 10%. And we got 2,066. Okay. So now our liability amount is going to be the note amount minus the discount. Okay. 25,000 minus the discount minus the amount of interest here. Okay. So we're going to take 25,000 minus 6,217 minus 1,878. Wait, no. I'm sorry. That's not right. I got that answer. I'm like, wait, that's totally whacked. I meant we got to take the amount of the discount and subtract out what we've already discounted from that. So 433.9 is subtract that from 25,000. So it should be 20,661. I'm so sorry. 2661. And then for 2028, we're going to do the same calculation where it's 25,000, but this time it's going to be minus both of those interests. So 25,661, 25. I don't know what my brain is today. Minus 1,878 minus 20. The discount amount of what was it again? Wait, is it here? 6,217? 6,217. I got that. This is the discount amount. I keep screwing this up. Discount amount. We're subtracting out what we've discounted. Because this is a 3-year note. And that's the big, like, we're the last bit that we aren't discounting here because it shows only 2 years would be the last year's discount amount. Anyway, we're going to subtract out the 1878 and the 2066. Now subtract out the 25,000, and we should get 22,727. And I hope I did this right, because if I screwed this up, all right, good. I was going to say, if I screwed that up bad, then that would have been bad. All right. Oh, I just got a notification. Okay, let's go to the next one. And now, oh, cool. We're doing a like kind exchange. Give me a second. I need to, I'm going to pause. I had to get a drink and I'm almost out of water, so I got to get more. All right, I am back with you. Cedric Company recently traded an older model of equipment for a newer model. This is a exchange. Okay, the older model's book value was 180,000, original cost of 400,000. All right, 200,000 community depreciation. Fair value was 200,000. So we have about $20,000 difference there. Cedric paid 60,000 to complete the exchange, which has commercial substance. All right, record the exchange of the assets. Let's start off by doing what we know. The cost was 400,000. Accumulated depreciation was 220. So we're going to debit the accumulated depreciation. 220. Let's just put this down here. Old equipment. Does it say old equipment? Oh, yeah, equipment old. It was 400,000. Okay. We paid 60,000 in addition to its fair value. Okay, so we should be doing 260,000 for the new. Okay. Oh, and we paid cash, duh. My cash is glitching. My computer is glitching, not cash. 60,000. Okay, so let's find out if we have a gain or a loss here. 220 plus 260 plus 4. Oops, minus 400. So it looks like we have a $20,000 gain. So I leave this space in between here because I don't know if it's a gain or a loss. So I leave that space in between them and try to figure that out. $20,000. Is that it? Oh man, that was easy. That was fun. All right, next question. Oh, it's the same thing. Per journal to record the exchange. What's different about this? Is this the same exact one? Fair value, I think, is different. 170. Yeah. All right. So this is probably gonna be a loss. Spoiler alert. Okay. So we're basically doing the same journal entry, accumulated depreciation. Um, equipment new. I'm gonna leave a space, equipment old, and then cash. And we're just gonna plug and chug for the first part here. Old models book value, let's say 400 and 220. I don't remember if the cash is the same. Yep. And the fair value for the new equipment was 170 plus 60 is 230, I think. That's 250 minus, I'm sorry, 450 minus 460. 10, lost 10,000. Yes. Long. Constructed a new manufacturing facility for its own use, its very own use. Um, the building was completed in 2028. The company borrowed 1.5 million at 8%. Oh, this is one of those ones where we got to do the weight, how much it was there, come up with how much is capitalized. So, yeah, all righty. At least this one walks you through it. I think the one in the that when I did the video was kind of wonky. All right, so let's do the expenditures here. We're just going to copy them down from what was there. 600. The weight here is 12 divided by 12. Then 120. Oops, add a zero. March, April, May, June, July, August, September, October, November, December. Don't be ashamed of doing the fingers. June, so that's 6 because it's at the end. If it was at the beginning, it would be 7. September, October, November, December, that's 3 months. And then December is 0 months. So, all right. So then 800,000, 600,000, 400,000. Oh, I don't need to do that math. Do the 9 divided by 12 of the months thing first, and then it'll be easier to do the calculation. You don't have to remember anything. Ah, see, and I just said that. It is 0.5 though, but I just did it. Yeah, I jinxed myself, I think. I don't know if they want you to put a zero there, but I'm going to put a zero there. Okay. So average accumulated expenditures is a 2 point, this what we just calculated up here. Then here we need the construction loan, which was how much? 1.5 million at 8%. We have anything else? Okay, we had 5 million in bonds and 3 million as a long-term note. I don't think we use the bonds. I can't let me think about this real quick. Oh, we gotta come up with the weighted average, I think, on it. That's what we did. So let me get Excel out because Excel will help us do this a lot better. So the weighted average of the other debt, we had them at 5 million at 12%, and then 3 million at 12%. Does it give us when they were outstanding throughout? So 0.08. So what do we get here? Just multiply these across. Oh, right, because this is the interest we're looking at here. So the amount, oh, so we have $840,000 of interest in the other debt. So what we're gonna do is add up these two. So I'm running through the process in my brain too. Helps when I can see that they're amounts. Okay, so we need to come up with our weighted average interest rate. 11%. So we're going to take our other loans and do the weighted average of them. At 11, what was it? 11%. You know what? That was a calculation. Oh, it is 10.5. I'm glad I thought to do that. Okay, so there we go. That's it. Okay. Check our work. For some reason I thought we had more to do. What did I do there? I'm gonna pause and think this one through. All right, we're back rolling. I think I figured out what happened and what I did. I wasn't sure that I even covered this in the video, so that's why I was confused when I was looking at this. Because this other loans, they're not construction related, but our average accumulated expenditures was higher than our construction loan. We're gonna subtract. I just thought this. I don't even know if this is gonna do it for us, but if I subtract, yeah, I'm willing to bet it's this 550 right here because we're basically putting too much money in here to calculate for loans above our actual expenditures. I don't remember that actually coming up in the video. Let's see if that worked. That's the only way I can figure out. Okay, so just make sure that when you're doing these that you don't exceed whatever the average accumulated expenditures are, which is what I did with the other loans. Your construction loan stays here, but if you had more expenditures, then it's assumed that you're using these other loans to help fund it, but only up to the accumulated expenditures. That's basically what I'm getting out of this problem. Sorry that that one was a little, like I said, chapter 10 is full of these just little things that they like to throw at us. And even when I'm doing these and looking them up, I'm like, man, it's kind of crazy how all this stuff is, you know what I'm saying? So, all right, anywho's, let's go ahead and, sorry, I get some, I just finished this one off. It got me my other one when I earlier, but my trash is overflowing with water bottles. Not that you care or even know about that. Okay, we modified our Model Z2 satellite to incorporate a new communication device. Awesome. Here's our following expenditures, blah, blah, blah. Equipment will be used on this and other research projects. So that's our cue there. Other research projects. We're only going to be able to do the depreciation on that. And that was $10,000. During the year-end review of accounts related to intangibles, you discover that the company has capitalized all of the above as costs of the patent. Can't do the accumulation, acquisition of the equipment. Management contends that the device simply represents an improvement of the existing communication system and satellite and therefore should be capitalized. Prepare correcting entries that reflect the appropriate treatment of the expenditures. If there is no journal entry, make that happen. Okay. So what we need to do is, let's see, they capitalize this. So we're going to need to do a journal entry that will reflect it being an R&D expense. So let's go ahead and debit R&D expense. And what is it? Is it a patent or? Really wish they would tell us that they did capitalized it. That's fantastic. Oh, patent. There it is. Okay. I was gonna say it'd be nice if you told us what type of asset it was. So we're gonna move stuff out of patent into R&D. What does this include? Basic research to develop the technology? You bet. Engineering design work? Yeesh. Development of the prototype device? Yes. Acquisition of the equipment? No, at least not initially. Testing and modification of the prototype? Yes. Legal and other fees for patent? No, that's patent. That's fine. Legal fees for successful defense of the new patents? That's fine. So we're going to pull out those. And we got 2 million plus 680,000 plus the 300,000 plus the 200,000. So we got to move to R&D 33,180,000. Okay, that's what I think anyways. What's the next one? Record the correcting entry for the equipment, if any. All right, what's the equipment journal entry modification? Well, we put 60,000 in there. We shouldn't have done that, right? Because we're going to use it for other things. So we need to debit the equipment and credit patent to remove it from the patent. I'm guessing the next entry is going to be, yeah, 60,000. I'm guessing the next entry is depreciation. Yeah, so we're going to depreciate this into research and development for 10,000 is what they said it was, and then the accumulated depreciation for the equipment. Okay, that's what I think anyway. Sweet. All right, you made it this far. One more question. We got this, guys. Okay, early in 2027, the Excalibur company began developing a new software package to be marketed. All right, that's cool. Project completed in December 2027 at a cost of 6 million. Of this amount, 4 million was spent before technological feasibility was established. Excalibur expects a useful life of 5 years. A new product with total revenues of 10 million. During 2028, revenue of 3 million was recognized. Okay, we're just looking at 2027 development costs. So now all that revenue and stuff is not that big of a deal. Okay, so what we got to do is we got to figure out what is going to be included in those costs. Okay, we got 4 million was spent before technological feasibility. That means it is R&D. Okay, and then it was 6 million, 4 million. So it was software. So we gotta find something that says software. Okay, software development cost sounds good to me. Oops, let's add a 0 in there. It's 2 million. And did it say we paid cash or was this? I mean, I guess it says it cost 6 million. Okay. Doesn't say if we use cash or not, so I'm just going to assume it's cash. 6 million. Check it. Check it. Check it. Check it. Yeah, we're done. All right. That is it, guys. We did it. Chapter 10, homework assignment. I know it's a doozy. Chapter 11's promising to be a doozy as well. So hopefully that won't be too bad. For some reason, it looks like my sync is off by like a half second. I hope that doesn't come through in the video. Anyway, you guys have a good one. We'll see you guys in the next video.